is the Demergers of UK corporates. Okay. My name is Paul Davison, and I'm a director of PD Tax Consultants. I'm a chartered tax advisor and a certified accountant. And we've got my colleague Ryan Snape, who's helping out today. He's a senior tax consultant. He's actually a CTA, but it doesn't say that on the slide, but he is a CTA. PD Tax, well, our vision is to enrich lives by making tax simple. Because by definition, tax isn't simple, and we make it simple for our clients. So in essence, that is what we're about, really. Client service. That's at the heart of what we do, and definitive advice. And what I mean by definitive advice is we tell people what we would do if we were in their shoes, effectively. Obviously, we'll provide the ins and outs of every situation, but we'll steer people in the way that we think is appropriate given the tax situation. And it's always important, as far as we're concerned, that the clients pay the right amount of tax after all reliefs and etc. are applied. So what do we do? Well, obviously we provide tax advice. That's the core of our business, really, tax consultancy. We do that for clients, business people, wealthier people, Joe Blogs. We do tax for Joe Blogs. And we do tax for accountancy firms with our tax director service. We do some tax return work, share valuations. Sometimes people don't realise that we do that work, of private limited companies. And we do tax investigations and voluntary disclosures. So the usual slide on housekeeping. We started at 9:30. We're going to finish at 10, but then there will be some time afterwards if you want to for a breakout session where you can pick Ryan and my brains for 10 minutes about Demergers if you see fit, and if you want to stay on the line. Your mics will be disabled though until 10 o'clock. So please submit any questions via the Q&A box, and Laura will ask those questions at the end. If your question isn't answered because we don't have time, then we'll contact you for a follow-up discussion. As I mentioned, there is a breakout session. And as ever, the usual caveat, this presentation is for general information only and is not intended to constitute advice. It's recommended that you seek competent professional advice before taking any action. Okay, that's the introduction is done. Now we're on to Ryan. Ryan, over to you.
Thank you very much, Paul. So we'll start with exactly what is a demerger. Possibly some of you are familiar with them already, having chosen to attend the webinar. But nevertheless, so we'll go through sort of the basics of what a demerger involves. And what it involves is the splitting or division of a trade, or well, more than one trade or business within a company, into separate corporate entities. I've noted that there's generally two types of demerger, and I'll go through those in a little bit more detail in the next slides. And those are a partition demerger and a non-partition demerger. The partition aspect refers to the shareholders themselves. The business is going to be split nevertheless, but it's the partition refers to those shareholdings. And what a demerger allows is the previous trades in business to continue via separate corporate entities independent from one another, whereas before they would have been within the same company. So move on to the next slide. In fact, I'll run through a non-partition demerger first. Will be better. So in this example, this seems to be reversed actually. So the starting position is actually on the right hand side. I don't know how that's happened, little bit of a technical difficulty. However, if I can draw your attention to the right-hand side of the screen, this would be the before position. So we've got shareholder A and shareholder B that are each 50-50 shareholders in TradeCo. And within TradeCo, we've got A and B, which could be trades, they could be investment businesses, they could be a trade and an investment business. However, they're going to be separately identifiable businesses. Now, under the non-partition demerger, the overall, the shareholdings aren't going to change. So you'll see on the left-hand side, which is the post structure, we've got shareholder A and B are still 50-50 shareholders in TradeCo, but TradeCo now only has the A trade within it. And on the right-hand side of there, we've got shareholder A and B still have 50-50 shareholding, and that separate corporate entity just has the B trade or business within it. These are quite basic examples, and typically, as Paul might cover in his section, there's normally one or more holding companies or dormant companies that need to be involved as a part of the restructuring, and no two demergers are alike. But that kind of demonstrates what a non-partition demerger would do is the shareholdings and interests remain the same. And an important point to note here is that, shareholder A doesn't have anything more than he did before. The only difference is that those companies are now split. So if we take the example that, say, the A and B trade were each worth £500,000, then before, shareholder A had a 50% interest in a company worth £1 million. Now he's got two 50% interests in two companies worth 500,000. So he's got 250 interest in one, 250 in the other. He's still got an interest of £500,000. And that's an important principle of a demerger, is you can't use it as a means to change those interests. So if I move back now to the partition demerger, which again is back to front, but if I draw your attention to the right hand side, we've got, as before, shareholder A and B both have a 50% interest in TradeCo, and TradeCo carries on to separate business ventures. Well, afterwards, so what we've got is shareholder A that has 100% interest in TradeCo, which carries on the A business, and the B shareholder has 100% interest in NewCo, which carries on the B business. So the shareholders themselves have been partitioned from one another. They can now go off and carry on those trades independently from one another. Now, as I mentioned before, we can't use that as a means of passing value to any one shareholder. So it's important, certainly with regards to a partition demerger, that we understand the values of the A and B trade, and where in almost all cases those values are going to differ, there needs to be some kind of a balancing transaction to make sure that the pre and post position, the interests of the A and B shareholder are the same. So, for example, if the A trade were worth more than the B trade, then in this example, we might have to consider the A shareholder transferring something, taking on a liability or transferring some cash to the B shareholder to ensure that the pre and post position is the same. So that's an important aspect of a partition demerger. So why might we want to undertake one or more of these transactions? I'm just going to run through a few examples here that we've come across, typical examples. The first one is divorce. We had a case a few years ago where a husband and wife were ordered by the courts to divide their assets between one another, and they had 50-50 interests in a property investment business. Now, if we were to distribute those properties from the business and to the shareholders, we're going to have chargeable gains, probably going to have stamp duty, land tax to think about on the shareholder acquisitions. So ultimately, it's going to deplete the assets that are available to divide on divorce. So the demerger offered a commercial solution to this. What it allowed us to do was a partition demerger, because obviously that company couldn't continue with husband and wife now that they were divorcing. They needed to go off and carry on their businesses separately. So the partition demerger offered a commercial solution to that, is in that we were able to divide the property portfolio and have one husband take his share into his own corporate structure, and wife take her share into her corporate structure, and then proceed independently from one another. There's mentioned there about on the fifth bullet point, shareholder fallout. That's very similar to divorce. Partition demerger might offer a commercial solution there. Or if they just want to take the business in different directions, if they've got different ideas about what they want out of the business and that's going to cause friction, then it might be better to split the trades or to divide the investments and take those into separate corporate structures. Separating out the business for sale is a good one. If you have, let's say, a buyer or potential buyer who comes along and says that I deal in the A industry and I would like to acquire the A trade from you, but I don't want to have anything to do with the B trade, so I don't want to buy your shares off you. Well, in that scenario, we might have to look at selling, say, the A trade or assets from the company. But the issue we have there is that there's going to create gains within the company, and then we've got the additional challenge of getting those funds out of the company into the shareholders. So it's not necessarily very tax effective. If we were to undertake a non-partition demerger, what we can do there is split out the A and B trade into separate corporate entities, and keep the same shareholdings and shareholder interests of whoever owned it before. And then those shareholders can then sell those shares to the buyer of the A trade, and they can get that as a capital transaction, which is obviously much more tax effective. And subject to, and Paul will cover this in his section, is subject to getting the demerger structure right. It may be possible to also ensure that the sale of the A shares qualifies for business asset disposal relief, which is going to be even better for those shareholders. There's a couple more reasons on there as well. You know, separating out different trades anyway is good from a risk point of view. Putting them in separate companies, it means that A trade is not going to be at risk from the B creditors of the B trade, and vice versa. So that's in general is just going to be a good commercial objective. And then there's also mentioned there, oftentimes we come across businesses that have accidentally sort of carried on a trading business, but have built up an investment business over time. Well, that investment business is going to cause risks to some very important tax relief, such as business property relief for inheritance tax and business asset disposal relief for capital gains tax. So in order to protect those, we might want to separate out that investment business via a non-partition demerger. But the important factor to sort of convey here is that we need a genuine commercial reason for demerger, and that is going to be the backbone of obtaining any formal clearance from HMRC for the demerger application. So it's important to have one or more commercial reasons, and these are the types of things we need to be thinking about when we're looking at a demerger for our clients, and their reasons for it. So I'm going to given that I've been through that, I'm going to do a short poll now. For those of you that have come across demergers before, you might have come across some of those reasons, and you might have some of your own reasons. And then also, you know, given what we've discussed, I wonder what you might think might be one of the more popular reasons for that a company owner would want to undertake a demerger. So I'll if you have a look through the question there and the answers, I'll launch the poll in just a second. You can have 30 seconds to cast your votes. Oh, apologies. Laura, I'm struggling to find the polling button. Oh, here we go. There we go.
I was going to say, sorry.
I found it now. Apologies. Yeah, sorry. So 30 seconds, cast your votes now. That's great. I think the majority of you have answered now. And yeah, the standout one there is shareholder fallout divorce. And I think that's probably one of the more common areas that we do see. But I would say that we do see all of those reasons. We have seen all of those reasons come through over the years. And all of them are very much important commercial reasons for undertaking a demerger. So yeah, it's possibly something to keep an eye out for clients. Okay, so Paul, if you're ready, I'll kindly pass back over to you to take us through the final points of what a demerger involves.
Thank you, Ryan. Okay, right. So we're going to move on to the types of demerger. People who've considered this may well have seen these terms banded about. The first demerger is the statutory demerger. This has been around for a long time. It's a relatively simple structure, but the main issue is, well, there's two main issues. There's a whole host of conditions that have to be met for the reliefs to apply. And we can't do this unless you have two actual trades. We can't do it for, if there's any investment business or property moving around, we can't do a statutory demerger. So just as a flavour for that, I think I've been doing the demergers now for about sort of 10 years, and I've only ever done one statutory demerger in that time out of about 10 or 11. The main benefit is that if you can fall into conditions, you do end up with a slightly simpler structure once the restructuring is completed. Okay, so but it is unusual these days to do a statutory one. Section 110 was very popular because Section 110 gave you the ability to deal with trades and with investment business, property, etc. So Section 110, you could do almost any type of demerger you wanted, a partition demerger, a non-partition demerger, as Rise explained, one or more businesses or investments. But I suppose one of the problems with that is that actually some people think, well, I'm involved in a liquidator because we have to set up a new company which is effectively liquidated under a Section 110 Companies Act procedure. And a lot of clients are saying, well, actually, how does that affect me? Because I've got a liquidation. I don't like that on my record in terms of Companies House. I don't see that as being a problem, but obviously one of the issues is that when you do a liquidation demerger, you have to pay a liquidator, which adds to the costs, adds to the complexity. So when the capital reduction demerger came into play several years ago, when they changed the rules on this, and people started to understand it, that type of demerger started to gain momentum because we didn't need to use a liquidator, and we can do it for trades and investment. So these days, the capital reduction demerger is the most popular one and probably the go-to method of doing it. So every type of demerger is going to need a clearance, HMRC clearance, before we do this. And every demerger is going to be different. We're going to have different things moving. We're going to have businesses moving. We're going to have assets moving. We could even move cash. We can move liabilities. We can move anything because what we're doing is doing it via distribution. So we're splitting up the company in virtually any way you see fit. But the result is important for the shareholders and important for the business. You know, one side of the company might need the cash. We might want to take the cash, leave the cash in the trading company so that when we sell that or liquidate that in the future, we can get that cash out at 10%. So there's whole different ways and things we're going to do to skin the cat, as I put there. And the outcome, so we're working towards the outcome. What is the outcome the client wants in terms of the shareholdings and the assets? And we're going to do to achieve that, every single demerger is going to be structured in a different way. And we'll see later, there are some methods which have become more prevalent, but everyone needs to be done differently. Therefore we've got to go through every single step and look at the tax. There's lots of different tax points to look at for stamp duty, SDLT, degrouping, personal distributions, disposal of assets by companies. We need to look at each separate disposal, each separate chargeable event, and work out where the relief is. And that's going to be important for every single demerger we do. If we don't do that, we can't sleep at night. So just onto a couple of just a couple of little points to think about when you do demerger. Stamp duty, we are moving shares around, so it's going to be stamp duty. And one of the things we tend to do is we tend to put in, one of the first steps is put a holdco above the existing holdco to keep it the sort of group structure. Now, there is a relief for that under Section 77 FA 1986, but a few years ago they brought in Section 77A, which is some anti-avoidance, which stops that relief from applying where somebody's taking control of a company. Now, they did then in 2020 make some adjustments to that to make it more lenient. But when you're doing this particular piece of work, look out for this stamp duty relief, because when it comes to doing the demerger, it's only 0.5% on the shares. But if the client ends up with a bill of £10,000 for stamp duty and they didn't realise they're going to have to pay that, and that's going to be something to discuss with them later. So look out for Section 77A. Business asset disposal relief, another important one, because what we want to do really, we want the client to move on and be able to sort of sell the trade sometimes quite quickly, because they're doing this to sort of segregate assets, segregate trades out, and then sell one. Now, if we're doing this, we need to be careful about which trade we're going to split out of the existing group. And the reason for that is that if we split a trade out of an existing group into a new company and a new group, then we could fall foul even of the director employee test, because the companies over here are new. And even though those companies might sit in the shoes of the old shares in terms of the 2-year test for the 5% test, you might not have been director or employee of those companies for more than 2 years. So a bit of care there required about which the companies you're going to sell after the demerger, and so how you split those two up. The uplift in the base cost is something which is really nice for the clients. 2011, they changed the rules so that on a degrouping of this type, that's what we've got assets moving away out of a group into another group. We changed the rules to quite a significant extent. What it means now is that if just before you demerge an asset, you have an intergroup transfer, a 171 transfer. So if you were to transfer a property, say, from an existing subsidiary into the new subsidiary you're going to demerge, and then demerge that new subsidiary, the property within that company could well gain, and actually will gain, a uplift in its CT base cost to the current market value with no tax payable. It sounds too good to be true, but it is right. Go on any good website, any good sort of tax magazine website, and check it out. It is correct. But you do need some care as to how you move that into the subsidiary, because you've got to be careful with SDLT. So if you're doing a demerger, what help might you need? Well, obviously, sometimes you need a valuation, because you need a valuation to work out what the comparative companies are worth. So what the comparative trades are worth, to work out how many shares to issue when you're doing the demerger, and to work out what the share premiums might be in the different places when you're doing the demerger. So sometimes you're going to need some share valuation work done. I would say you're always going to need a solicitor to do the paperwork and look at the Companies House Act requirements. And also you're going to need some care about accounting to make sure you've got the sufficient distributable reserves to make the distributions you've got. Because if you don't, you have to look at as to how reserves could be created through some sort of revaluation or etc. But it does need some care that to make sure you've got the right results there. No, actually, we're running a bit behind time. Really, we don't have time to talk about any recent demergers because we've only got 5 minutes left to deal with questions. So yeah, every client's got different circumstances, and this, even though it seems simple, it needs care. So you can call Ryan or myself if you would like some assistance. The next seminar is actually a seminar. It's actually an in-body seminar, and that's on the 29th of October at Weetwood Hall. And we're talking about the budget, which is a few days before that. And then the next webinar is 12th of November, UK tax residency for individuals and the impact of COVID. Right, Laura, got any questions to talk about? We've only got 5 minutes to deal with these.
Yeah, so the first one is asking, does a demerger, for example, on divorce, have to result in the shareholders of the new company having the same value of business interests as in the old company? For example, where 50% shareholder in the original company takes 45% of assets into the new company in order to not incur SDLT and other taxes.
Well, yes, yeah, it does. It does and it doesn't. I think the one that we did, Ryan, they had the same value, didn't they? I think after the divorce.
I think we had to look at a balancing amount of cash because
yeah, that's right.
Because of course you've got a property. We had a property portfolio there. We were never going to get a 50-50 split on the property values. So that's the shareholder taking the larger share had to balance that, I think, by taking on a liability and transferring some cash alongside it, so that the overall values were the same before and after. So it can't be used as a means of kind of just changing the shareholder interest. There has to be, but in order for these demergers and reliefs to work, there needs to be kind of equality, whether that be in the sort of trading assets being transferred or some kind of balancing transfer to make sure that equality.
I think it's an interesting question because with the one we did, there's actually some doubt about who owned the shares in the first place. It's 50-50 in the first place. So there's always the facts need to be. There's two things. The facts need to be established. The second thing is, Brian's right. The demerger is really going to be only for sort of equalising the interests. Obviously, once you've got those interests, during the demerger, you could potentially move. You could potentially change. You could load one side with cash and give that person more money. But the problem is with that is that you could end up then with some sort of transfer of value, some sort of value shift. Because what you've got is a transaction whereby somebody's gaining and somebody's losing from the transaction. So you've potentially got a value shift. So then you have to work out. And then it gets complicated because you've got to work out the rules for husband and wife, and when that value shift occurs. Because does that value shift occur in the year of their separation, or does it occur after the separation? If it occurs after the separation, how can we try and relieve that value shift? So the answer is you sort of can, but it needs some thinking about it. It would need. It's not just if you're going to do it. It needs more than just a straight demerger to make it work. But the demerger would be the right tool, but you'll have to think around the subject to come up with the best solution. Time for one more question, Laura.
Yeah, a company sold a trading asset some years ago, incurring a large gain, and bought 4 hotels to obtain rollover relief. Shareholders would like to demerge the hotels into separate companies for a risk reason and also to possibly sell the hotels separately. Would this crystallise rollover relief?
Oof. Well, answers I don't know. My gut says it wouldn't, because you're doing intergroup transactions, and intergroup transactions don't tend to crystallize rollover relief. But because you are demerging them as well, whether that would give you an issue with, because you're degrouping it, that might crystallize the rollover relief. But if you think it through, what we said today is actually you can get an uplift in the base cost of these hotels. So if you did it right, you'd get the uplift of the base cost of the hotel will be uplifted to the current market value, and the actual sale would be for no further tax. The question is, can we avoid the rollover crystallization? And unfortunately, I can't answer that question here because it's complicated. But I'm sure we can have an offline chat with whoever's answered that question, Laura.
Yeah, if there's any other questions we haven't got time to answer, we can get back to you in an email with an answer.
Yeah, thanks, Laura. That's brilliant. Okay, everybody, well, hope you've enjoyed that. It was quite a quick run through of Demergers, and obviously we didn't get into the technicalities of them, but that's what we're here to help you with, really. It's quickly what we try and do is tool you up to understand how they work and when they work and what benefits they have. So I hope you've enjoyed that. We'll stop the webinar now, and we will, if you want to stay on the line to join the chat, please do so. Thank you. Right. We've got a few people left on, so I will allow you all to talk. Again, allowed to talk, allowed to talk, allowed to talk, allowed to talk. Right, I think you're all, everybody's mics are now activated, so if you want to ask any questions of myself or Ryan, please fire away.
Can I just say that on the demerger in a divorce situation, wouldn't if it was the demerger was embodied in the court order, would that get over the adverse tax consequences?
I don't know when it gets over. Does it ever? It gets over stamp duty, and it gets over SDLT. I'm not sure. Does it get over? I can't remember. Does it get over the CGT?
I think it does, but I'm not sure. Having said that, I did have a divorce case a few years ago where they forgot to do a holdover relief claim, so maybe it doesn't.
Was that your question, Colin, that you asked us during the?
No, no. I just made a comment about the divorce, about the court order. It wasn't a question. Well, I asked a question. Yeah, would a court order get over the tax consequences? Yes.
Well, it's like any divorce. If you've got a disposal of assets, how do you get over that? How do you get over the disposal is the question. So if it's via if it is via a court order, does it get you over? I can't remember if it gets over or not.
I think it won't get over the capital gains tax consequences. Having thought about it initially, I thought it might, but I don't think it does.
I don't think it does. I think you have to avoid the CGT, and if there's any CGT disposal, I think it has to be during the year of separation to automatically get you over the line.
Yeah, and if it's a property business, then presumably you can't hold over the gain.
No, we did do one. Oh, it wasn't a divorce, was it, Ryan? We did one recently where there was a property divorce, but the properties weren't held in a company that I held personally, and we did there's that rationalisation relief in section 254 or something.
Yeah,
Maybe-
yeah, that's right. Because they all owned it jointly, so it was kind of deciding which ones they wanted to own outright separately.
Yeah,
You kind of get there's relief around the values being transferred, obviously subject to one party getting more than the other, in which case that might well realise part of the gain.
yeah.
So that's obviously a good result where there isn't a corporate structure in place. But more often than not these days, people are owning their properties in companies rather than personally.
Yeah.
I did ask the question about the hotels.
Did you?
Yes.
That's a tricky one. I could find the answer out for you, but I can't do it. I don't know the answer off the top of my head, unfortunately. We can work through it. We can work through it, obviously.
Yeah.
What's your have you concluded on that or not?
I haven't. It's to be honest, this seminar's made me think about the possibility of the demerger.
Well, it does make sense because you're going to get the uplift in the base costs for the hotels,
Mm-hmm.
and I don't think there's any anti-avoidance that says you can't sell these hotels straight away. I think the uplift is pretty much set in stone, and all commentators believe the uplift exists. And actually, the government did change the rules to bring goodwill in line with tangible properties in relation to this particular point. So they must accept it. It applies. I have had one go through the mill. So we demerged one in 2014. There's a piece of land which we put into a separate company. We created two new groups, and the piece of land went into the second new company on its own. It's just a piece of development land, but the piece of development land at that point had got planning permission, so it was worth quite a lot, about £2 million, and then they sold it about 4 years later. Claimed the £2 million base cost, and HMRC didn't look into it. So yeah, but I think that makes sense with the hotel transaction, certainly.
Okay.
Got to be careful. You have got to be careful how you move it around, because you've got to be. I could tell. Just be careful, and I don't want to give the answer because the case is different. But you've got to move it in the right way to avoid SDLT.
Yeah, well, I wouldn't be doing it on my own, so.
Well, we're here to help, obviously.
Yeah. Well, it's a possibility.
Thanks, Colin. Appreciate that. Thanks for your questions. They're interesting. Anybody else want to take up 5 minutes of our time? Any other questions or things to discuss or comments or nothing at all? I think I was going to talk about an example that we had, but I didn't have time in the end because Ryan took too long to do the poll.
Apologies.
But the example we're going to mention was where we had a company which they took a load of cash out of the company to buy a house for themselves, and they didn't realise that they'd have a Section 455 tax issue. So they had about £1.3 million, Ryan, of a loan from the company.
It's quite a large amount, yeah.
So what we did was we ended up. They had some sundry properties as well, owned personally, and they had some properties in the trading company. So what we did was we sold the personal properties back to the sort of investment properties back to the trading company. We had to pay some capital gains tax, but not much, and some SDLT, but there wasn't significant amounts given the numbers. We sold the personal properties back to the trading company, which effectively settled the loan. And then once the properties were all in the company together with the existing properties, we then demerged all those properties into a new company. So we now got a trading company and an investment group over here. So it's perfect in terms of the sort of the silos. And then we looked at this, as we did that, we then started looking at the sort of shareholding in the investment company in terms of creating some sort of family investment company and trying to restructure the shares in that company so that value passes down to the family, to the children, etc. over time. So that was a pretty good piece of work we did. And probably will save them a lot of tax in the future. Anybody else?
I think you might have broken up a little bit there, Paul. Yeah, well, if there are any further questions, I think our contact details are in the.
Can you still hear me or not?
Slides. Oh yeah, I think you've come back now.
Right. Okay, guys. Well, I hope you enjoyed that, and we'll be in touch in the future.